All right, so here we're going to look at what we call our markets principle, and we can think of markets as the way we access different types of investments. And that's really going to be a key component as to determining our investment strategy. So this is sort of step 2 in the investment process. So the first step being we want to understand or define what our investment philosophy is. And there's a number of different investment philosophies we can, but depending on what they are, so again, philosophies being what we believe to be true about, in this case, investing, that's going to guide the types of investment strategies that would fit within that. So different investment beliefs are going to, different investment strategies are going to fit in those or not. And so we look at markets as a way of implementing that strategy. And then obviously we're going to then have the tactics of the actual decisions we make on what assets we buy and sell, but that's going to be driven by our investment strategy. So the primary driver of that's going to be essentially what we call markets. And we think of markets as ways of accessing those investments. So we're going to delve into basically, fundamentally, there's 4 different types of markets, okay? And so we've got our, from an investment strategy perspective, we can invest in markets, that is, we can buy the entire market. We'll talk a little bit about what that looks like. We can invest via markets, that is, we can use things like, say, for example, stock exchanges or bond markets to invest in the instruments that are listed on those markets. So, for example, we might want to own, a company. We might want to own a mining company. It's convenient to own that via, say, the listed markets because it's the company we want to own is BHP. We can access it via listed markets. So we don't really care about the market itself and what the total market is doing. It's BHP we want to own. So we're just happy to be doing that via markets as opposed to buying the entire market. And then the other thing we can do is we can invest across markets. So think of across markets being investing in more than one market. So we might invest in the Australian share market, say the US share market, European share market. We might invest in bond markets, be they corporate or government, or we might invest in commodities or foreign currency or other types of markets as well. So there's a myriad of different markets we could invest in. And we might take a view in terms of, and again, a lot of hedge funds will go down this path where they take more of sort of a macro view, if you like, and they're not really interested in the underlying instruments within those. They're just buying and selling relative percentages of those markets. We can talk about different ways that can happen as well. And then finally, we have the obvious one is we can invest in outside of markets, i.e. outside of formal markets. And that's really, think of that as a private sector. So we can own private businesses or private property or, private assets essentially held directly with the issuer, being, say Land Titles Office or, shareholdings in a public or private but unlisted company. Okay, so there are sort of the 4 different ways we can access investments. And again, depending on what our investment philosophy is, will drive whether some or all of those are appropriate or not. So now we're going to delve into each of those different aspects in a bit more detail to understand sort of the pros and cons and how they might work. So let's start with probably the most basic one, and that is what we call investing in markets. So that is, we're essentially buying the market itself. So this might be, say, for example, in Australia, we want to own the Australian share market. And so we can look at doing that a couple of different ways, but essentially that's going to be a quantitative type of instrument. We're going to buy, the All Ordinaries Index, for example, which is a capitalisation weighted index of companies. What that means is the number of shares multiplied by the share price equals the size of the company or the capitalisation of that company. And then those companies are ranked in order. So the biggest one, I think at the moment it's CBA, but CBA, BHP, whatever. And then we own a relative percentage of those companies based on their relative size in that. So if we took, for example, say the S&P ASX 200, we're going to own the top 200 companies, but we're not going to own them, 0.5% each. We're going to own, 10 or 12 or 13%. It's going to go into BHP or CBA, depending on how big they are. Right down to the 200th biggest company, we might only own sort of 0.05% of, or even less, because it's relative capitalisation weighting in the index. Or we might hold an index that's more like, say, the Dow Jones, which is an equally weighted index of the top 30 companies. So we hold, exactly the same amount of capital in each company, even though they have different capitalisation weightings. Either way, they're both quantitative measures. We're not making a call either way on the quality of one company versus the other. We're just simply saying, no, we want to buy that whole market. So think of that as an index or a quantitative type of investment. And there's 4 sort of different parameters we can use to look at why you might use, an investment in markets, as part of your investment strategy. We can look at cost. We can look at the relative volume, like how much of it is there to buy. We can look at what the probable returns are, what investors typically get out of this particular strategy versus others, and then also what's possible. like how much can you make compared to other opportunities? What are the wealthiest people? How much would they utilize this particular investment? So let's start with the cost. Pretty straightforward. Investing in markets now is an extremely low cost way of investing because of the scale and the simplicity of them. Sort of index funds, again, some indexes cheaper than others, but all index investments now are down to sort of, tens of basis points at the most. So very, very cheap way of investing, particularly if you want to get a very large diversification. So very, very low cost. In terms of volume, how much money can be deployed that way? Well, essentially it's not unlimited, but it's a very, very large number. It's probably the second largest volume of potential capital there is in the world is in listed markets. So again, no issue in accessing plenty of volume. The third one we look at is, well, what's the probable return? Do people generally speaking make more money in markets versus what people can typically make via markets and so on and so on? If we look at that, I would say that the probable return is actually probably, I'd rank that third. And the reason I say that is because most people, so everyone who buys into the index is going to get the index. Okay, so you're probably going to get a reasonable return, but the probability that you can do better, there are certainly other ways of investing that can definitely do a similar amount of, or if not better, return than that. So it's probably more like a 2 or a 3, and similar, and we'll compare that when we talk about investing sort of across markets. But again, definitely it's easier for people to make, it's more probable that people can make money investing via markets. There's more wealthy people that way, would be my argument. And certainly, it most definitely, when it comes to investing outside of markets as well. So, okay, so that's what we look at in from a probable sort of perspective. If we then look at what's possible, okay, this is where I think investing in markets definitely gets you at the very back of the field in terms of what's possible. In other words, again, by definition, you're mostly diversified. You are going to hold the winners, but you are going to hold all the losers. You are therefore going to be very well down the list of possible returns. And so there's a really important thing to consider, that if I'm going to invest via markets, via indexes, you can pretty much always find plenty of people who are doing better than you are, if that makes sense, because they're the ones you're going to hear about. You won't hear about all the ones that are doing much worse. Okay, so yes, it's also possible to do a lot worse than that. But the reality is, because you're very diversified investing in markets, then the possible returns are going to be by definition much, much lower, because you're just going to be too diversified to be able to essentially back only the winners. Okay, so the wealthiest people don't get wealthy by buying entire markets. It is a great way of protecting, because again, you're very well diversified. Really nothing individually can go wrong, but by definition and the result of that, therefore your possibility is not going to be as strong. So you need to be willing to accept the fact that you're probably, as an investor in markets, you're probably always going to find plenty of people, at least in the short term, that appear to be doing better than you. It's important to understand that we don't end up dropping this strategy because we're expecting the strategy to deliver something that it's fundamentally not going to be able to do. Okay, so if we compare that with, say, investing across markets, okay, we can think of across markets as more of as a sort of a hedge fund, right, or a macro-driven, or what we might call an asset allocation-driven strategy. So that might be a strategic asset allocation strategies, right, what we call sort of an SSA, okay? Strategic asset allocation simply says, hey, what's the relative risk return of a particular asset class? But when it looks at risk, it's not now looking at the risk of probability of return. It's looking at the risk being the volatility in the price. It's a very important thing to understand, and we've got other videos where we talk about that in detail. But if we look at it from a volatility as a function of return, the more volatile an asset is, the higher the risk under this definition. Okay, so strategic asset allocation simply says, hey, based on that, should I hold more international shares, Australian shares, property, infrastructure, bonds, etc., to come up with, essentially, this is a concept that they call the efficient frontier for investing. How do I get the highest possible return with the least amount of relative volatility? Often referred to as risk, but really what they mean is volatility. So strategic says, look, getting that right in the long term is relatively easy, but in the short term, it's a lot more difficult or problematic. Whereas a tactical asset allocation starts from that starting point of whatever the relative strategic asset allocation is, and then tries to take into account short-term factors that says, okay, well, look, in the long term, the Aussie share market and the US share market deliver relatively similar returns. So I might have them equally weighted. But hey, as I look at it today, maybe the Australian market is massively undervalued relative to the US or vice versa. And so you might deviate from those benchmarks over, say, a 3-month, 6-month or 12-month period, relatively short term, to try and take advantage of relative mispricing. So that's what a tactical asset allocation would do. It's still very quantitatively based, but again, with a qualitative factor, it's someone's making the decisions, either algorithmically or through some sort of other analysis, to say, hey, I want to put a little bit more or less towards some other version. And then you have the ultimate version of this, which is often referred to as dynamic asset allocation. You can think of that as constantly moving those relative weightings between different markets. Again, not necessarily based on the underlying shares in that market or bonds or whatever, just the broader market, and saying, hey, where interest rates are going or where that relative economy is or whatever macro factors might be seen to drive those things. We think at the moment we want to weight a bit more to bonds, and dynamic asset allocation seeks to do that, or twofold. One is tends to go for less volatile investments because, again, think of that measure of risk being volatility. Same return, lower volatility equals, lower denominator means a higher measured number. Therefore, dynamic asset allocation tends to push towards more unlisted or less volatile, and by that I mean less frequently priced, not necessarily less risky from a total return perspective or a distribution of return perspective, but less risky in terms of price volatility. Dynamic asset allocation tends to push you towards that. Again, not necessarily, none of these are necessarily right or wrong per se. It's very much driven by, is this the right investment strategy based on your investment philosophy? Okay, so your investment philosophy is going to ignore all of this and make them completely irrelevant to you, or going to drive you very much towards them, or some version in between. The investment philosophy is going to drive you to this point. But you can think of dynamic asset allocation as the more sort of highly frequently, again, not trading necessarily, more of a rebalancing than taking positions in and out necessarily. And then we get right through to things like hedge funds, where hedge funds might be taking very aggressive positions, which then might even be leveraged or have other use of derivatives, etc., to try and change the relative allocation between these different things. So that's how you might look at investing across markets. Now, how does that play out in terms of our matrix? In terms of cost, it tends to be really expensive. You're going to have performance fees, you're going to have very high management fees because there's a lot of things going on, and so you're going to pay a lot of fees. The classic scenario of the 2 and 20 hedge fund scenario, so 2% annual return and then 20% performance fee above a certain benchmark. The disadvantage of these funds is the vast majority of them just don't make very much money at all. But the ones that do can tend to be, can generate quite strong returns for long periods of time, and then therefore can make their founders and or key people quite famous. People like George Soros being a classic example of a long-term successful hedge fund manager. In terms of volume, I rate this as a 4 because the very nature of these things is you need to be smaller and more nimble. You don't want to be in a situation where you're managing so much money as you're driving markets. So really, there's a relatively limited volume. But having said that, in the purpose of the average investor, it's an absolute drop in the ocean. But there's less of these things can be sustainable because these are very much playing in the zero-sum game. Okay, their excess return has to be someone else's net loss of average return, if you like. So you can think of this as very much someone getting return that someone else is leaving on the table, because the market return sums up to the average, right? And that's where if we invest in markets, we're going to get pretty much the average return. In this, we're trying to very actively get better than that. Therefore, in terms of probable, I've rated this as sort of a 3. I can argue this one or in markets are interchangeably 2 or 3, because those who invest in this style, the probable returns are generally relatively low. And depending on the period of time you measure, they're generally worse than pure indexes. But there are some times, particularly when you've got major disconnection in market like GFC and the tech wreck and some other things, they can really cloud periods of measurements. But the probable return investing this way, we tend to find is relatively low. And so it's certainly not something we favour unless it's a very specific tactical sort of timing where we would do that. In terms of possible return, I've rated this a 2. And the reason I have is because if you do get this right, you can make a lot of money. There's no question. Some of the wealthiest financial trading people in the world have built their fortunes off doing this. Now, generally speaking, however, those that have done that have tended to be, let's just say, very effective for relatively short spaces of time, but made very outsized return. And again, I'll use George Soros as an example, famously shorting the pound in Great Britain, drove a lot of his early sort of gains. And then it gets very difficult to separate those who have been, let's say, very successful, because the success tends to generate more success in terms of allows those players to access better and better opportunities to a large degree. And then often when you do the analysis on their future performance, their performance comes down to more of the opportunities they're able to avail themselves of than necessarily any obvious skill of trading a particular strategy, if that makes sense. So it gets very murky and much harder to separate. But there's no questions, firms like Bridgewater and people like George Soros, there are some very famous, very long-term traders. And then you've got your Michael Burrys and some of those sorts of traders who have got one or two calls really right. That again have, you take those returns out, their performances may or may not be as good, but there's certainly one or two famous periods where they're highly successful. So you definitely can make a lot more money this way, and why it's often sort of super attractive. Okay, so let's now move across to how do we invest via markets? So again, in this case, we are still using, whether they be bond markets or commodity markets or, share markets, etc. What we're doing now, though, is we're just using those markets to get access to the underlying assets. So again, we'll continue the example of BHP shares. So our investment philosophy says, we want to buy certain types of assets. Mining companies, fit well within that scenario. We want to have a strategy for accessing, essential, companies that have essential products or services that are difficult to differentiate. There's some sort of investment philosophy that heads us in this direction. Investment strategy, therefore, is we want to own, materials and energy stocks, and BHP is one of the leaders in that. Therefore, we want to own BHP. That's a very simplistic sense, but that's what might lead us to want to invest via markets, because BHP is what we want to own, and the way to do that is via markets. So again, this could be quantitatively driven. We could do a whole bunch of sort of, accounting measures, price to book ratios or interest covers or other sort of balance sheet free cash flow, sort of quantitative analysis is, hey, what sort of companies do we want to invest in? And because with listed companies, that information tends to be much more readily available, it naturally pivots us towards investing via markets because we have that data and the relative transparency and reliability of that data. So it's that's driving the strategy more so than the universe of what we can invest in, more so necessarily than a specific company at that point. And then we just look to then utilize that to make the decisions. Or it might be a qualitative. It might be a sense of, no, we want to invest in enduring great companies that have been able to continually go through business cycles. Again, the philosophy that drives that way, and we might end up, again, owning, Woolworths or CBA or something as a result of that. Or it could simply be we take a very active approach, where we want to invest in businesses that we understand. And again, getting access to the right information allows us to get very, very close to understanding what do we think is the viability of a particular company. And that drives us to determine, okay, we want to invest or own that particular company. So again, different ways you might end up getting there from a strategy perspective. But again, investing via markets is just a convenient way to access or implement that strategy. All right. So how do we rate investing via markets? Well, from a cost perspective, it's pretty cheap. Not as cheap as indexing, but certainly a lot cheaper than private markets and definitely a lot cheaper than sort of hedge funds. So from a cost perspective, we rate this sort of a 2. From a volume, how much is there? Well, again, if we're going to be active, we want to be taking positions outside of the norm. So by definition, there can't be as much volume as there would be in investing in markets. And there certainly is nowhere near as much to invest if we invest outside of markets. So that's why we kind of rate this volume-wise a 3. But again, for all intents and purposes, for everybody watching this video, volume is never going to be an issue investing via markets. The next one we look at is, well, what's the probable return? Is like, what is, and the way to think about this is how relatively easy is it to get a pretty decent return, okay? And we rated this a number 1, okay? And again, not because if we compare this to, say, investing in markets, we rate more like a 2 or a 3, is because we do find it historically relatively easy to make reasonably good probable returns by investing actively via markets. And the reason for that is because it's relatively easy to find very good investments to buy and hold for the long term, okay? So again, here we're looking at probable, okay? So increasing the probability of getting a good return in the long term, okay? And we do think that that's relatively easy to do investing via markets, okay? Could be a little bit misleading, again, if you look at this as a pure definition and not properly contrast with the in markets. We're not saying necessarily that all investors via markets will probably do better than all people who invest in markets. From a volume perspective, that's probably, although the data is a bit hard to properly understand, but we're not saying that just investing via markets means you'll probably do better than indexes. In fact, the opposite of that's probably true. But the ability to probably do well is much higher because so many indexes don't do that well over time. It's very easy to find an index that's done better than the average active manager, for example. But if you look at, there's plenty of indexes that haven't done that. So again, if I look at indexes in total, again, I'd use the NASDAQ as one example, and then I'd use the Nikkei as another, okay? The performance of those indexes over a long period of time are polar opposites. So very different experience depending on which one you used. And there's lots of other different quant-based methodologies for investing. So again, I'm not saying that all in-market investments will do worse. That's not the measure here. We're just saying the likelihood of you picking a measure in markets versus via markets, it's relatively easy to get a slightly higher probability of return via markets in our experience. Okay. I've also rated this one number one in terms of possible return, and the answer to that is simply Elon Musk, Jeff Bezos, Bill Gates, etc. The returns you can get as an individual, okay, investing via markets is the highest there are. That's why the wealthiest people in the world are those who have done that. But let's be clear how they did that. They didn't do it by investing in particular companies in the markets. They did that by listing the companies they owned and having that price blow up. Okay, so keep in mind, particularly if you've got, a relatively small free float of a stock and a high demand, that price can be driven up very high, which makes someone like, Elon Musk, for example, seem like he's exceptionally wealthy because he owns a lot of shares and those share prices have gone up a lot. Now, if we would actually look at the usability of that value, and we can look at that in a different video, but the reality in terms of a practical wealth is Elon Musk wealthier than even, say, someone like Warren Buffett or particularly, say, someone like Bill Gates. From a free cash flow generation point of view, there's many different arguments on that. But if we were to look at it purely on a mark-to-market valuation balance sheet perspective, the richest people in the world tend to be the ones who have most of their wealth through some sort of very active position via markets, like those examples given. So that's what we're saying that's possible. Do I think that people, that the average investor, that is the highest possible return for them? That is certainly not the case. That's probably more we'll talk about when we come to the possibility outside markets, how wealth is generated that's more of a volume perspective. So I'm not saying the most wealth is generated that way, but I'm saying those that concentrate wealth, at least in terms of a measurement number, via markets is unquestionably the way that happens. And again, Elon Musk, Jeff Bezos, the Walton family, etc., the best examples of that. Okay, so final one, and probably our simplest in many respects, but also most complicated, is investing outside markets. But you can think of this as very simply everything that isn't via some sort of listed market exchange. So this is all private market. This is residential property, it's commercial property, it's all those private businesses. So from here, if we look at this, it's private, it's unlisted, right through to startups, essentially. So all those things that really aren't invested on those secondary markets, or what we would call the primary market from an investment perspective. So what does that look like from a cost point of view? Well, the costs are horrendous because running businesses and running these sorts of things, way more expensive than any of the other alternatives. Anyone who's been involved in business sort of knows that. So this is not an easy way, any easy path to riches by any stretch of imagination. If I look at it from a volume point of view, though, I do rate this number one because most wealth is generated this way. Okay, so even those who end up, on investing, having their wealth blown up via markets, like the examples we just gave, they still generate the vast majority of the foundation for that outside of markets. Okay, and there's way more wealth outside of markets than there is sort of, via markets or certainly in markets. So the total volume in terms of, is there room to play? There's way more room to play in this than there is for anywhere else, okay? But if I look at it from a probability perspective, it's definitely the worst. And we know this because most businesses go broke. Okay, so a lot of them might make a little bit of money along the way, but most businesses come to an end. Okay, most large ventures don't generate, even if they generate good returns for some period of time, over the long term, they don't generate anything like the sorts of returns that being able to invest, particularly via markets where you can keep changing between them, relatively easy because of that liquidity. Investing outside markets, way more difficult to do that, way more difficult to get in and out of those investments at reasonable prices at reasonable times. One of the reasons why companies with a reasonable enterprise with reasonable degree of success take that option for liquidity and divisibility you get by being on a market. So the probable return, I would say, is low. However, the possible is still pretty high, and I've sort of put this one as a bit of a 3, but keep in mind that that you can't make as much money in those markets as you can. And the easiest way to understand that is if you take a very successful enterprise and stick on the share market, well, then you can, just by blowing the share price up, you can be worth a lot more money, right? So investing via and in markets are always going to have a different sort of impact on that. But because of that relative concentration, if you move that to investing via markets, that's again what blows up the Amazons and the Alphabets and those sorts of shareholders, because that free float stock price now can amplify their relative wealth. So that's always going to be a lot higher. So that's why I've rated that sort of a 3. But I think the bottom line is most of the wealth is developed outside markets, if I look at total volume wealth. And so if people are playing the I want to make a lot of money game, this is actually where the vast majority of money is actually made. Okay, and if I look at the life cycle, people then tend to make their money in business outside markets. They then use markets, be either via or in markets, to diversify away from the relative risk of that, because those businesses ultimately can, and more often than not do, end up going broke at some point in time. That they use that as a way of passing that risk to diversify into other investments, either in, via, or even across markets. So that's where that interplay sort of comes out. So your investment philosophy might change over time because your circumstances change. You've started a business, it's become quite successful. It's reached the limits of its capacity to really drive that future growth, and/or you want to diversify away from the risks that can bring that undone. And therefore, you now start to look at either investing in markets, so you've got the ultimate diversification, or at least investing via markets where you can still take relatively active positions in businesses, but now have a lot more diversification and a lot less risk in terms of, different sectors and different economies and those sorts of things underpinning the success of your enterprises. Right, so that's the sort of detailed version. Obviously, there's a fair bit there, but the point of this is to get it all down so you can sort of watch this video a number of times, back and rewind and listen to as you need to. But I wanted to give it a pretty deep dive so that people can start to understand that this investment strategy side of things is often misunderstood or even totally ignored, because people go straight to I want to buy some shares, or I want to buy some property, or I want to buy some things. They don't even dream of thinking about, well, what should be the philosophy that drives all that? And therefore, they don't end up with a strategy that can actually potentially deliver on this. All of these strategy options can work, but they need to be driven the way they're driven, okay? It can be a Kia Rio, it can be a Bentley, it can be a Ferrari, it can be a, Ford Raptor, but you got to drive it. You got to use it like it's going to be used, and if you do that, you'll have a relatively successful outcome. If you don't, then it's just not going to. You're not going to win a Formula One race in a Ford Raptor. It's just not going to happen. So we need to have the right philosophy, line with the right strategy, and then making those tactical decisions become relatively systematic, because those two lenses give us a really good indication of what it is that we actually want to own. Right. So as always, if you've got any questions, by all means, let us know. But hopefully, that's given you pretty comprehensive insight into how investment philosophies, investment strategies, and then ultimately tactics that you end up seeing as the end result of all this, how they all come together and into play.